So let's begin. Good morning, ladies and gentlemen. Welcome to Meeting with Analysts. Today we will present you our new macroeconomic forecast, which was prepared by our colleagues from Monetary Department. Then we will hear a few notes from Deputy Governor Mr. Frait, and then we will open floor for your questions and further discussion. So let me introduce our today's speakers. So as I mentioned, Mr. Jana Fraita, Deputy Governor from Bank Board, and Monetary Department is represented by Mr. Petr Král, Executive Director, and Director of Macroeconomic Forecasting Division, Mr. Karel Musil. So let's begin with the macroeconomic forecast, please.
Okay, thank you. So good morning also from my side, and let me introduce the new macroeconomic forecast that we have prepared. I will start with a short summary and claiming that indeed the new projection is quite similar to the previous one, which is clear from the table that the differences between the new one and the old one are quite small. So it means that indeed the headline inflation will stay close to the inflation target. This is particularly true for the monetary policy horizon. The economy will gradually recover. The recovery will be pushed by the household consumption as the main driver, and this consumption will be supported by the elevated nominal wage growth over especially this year. Consistently with the projection is the modest decline in the market interest rate, so indeed as it was last time. Before I will go to the details of this new projection, I would like to spend some time on the discussion of the structural changes and the new equilibria that we introduced into the baseline scenario. And the reason is that indeed we somehow observe or identified that the growth model of the Czech economy is somehow changing, or it was changed, and it has an impact on the potential growth of GDP and other related variables that we are using for the projection. So it means that we change the equilibria for the baseline projection. For this projection, it's done through the expert judgments. For the projection that will be new during the fall, it will be incorporated consistently as a change of the steady states in the model framework. The change is related indeed to the potential growth, so it means that we recalibrated or changed the equilibrium from the previous value 3% to 2.5, including all the domestic components. And at the same time, as the potential growth is closely linked to the productivity, this variable was adjusted as well by the same magnitude. When we add to the productivity the inflation target, which is still the same 2%, then it implies that the nominal wage growth was recalibrated from 5% to 4.5%. And at the same time, when we are speaking about the potential growth, it's closely related to the convergence of the Czech economy to the Europe, and consistently with that, we also adjusted the real and nominal appreciation of the currency, and it was reduced from 1.5% to 1% as the new value. I already highlighted that these changes are related to the domestic components of GDP. We did not adjust it, export and imports. We did not adjust it, the foreign GDP that was done already in the previous recalibrations of the model. This changes still implies that the domestic economy is growing faster than our main trading partners. When we check further details or the motivation behind this adjustment, then we can simply say that indeed we just check past 25 years of the Czech development. We check or we analyzed roughly 30 time series, and we were searching for the structural breaks that appears during this past 25 years. What was the result is quite clear. There are a couple of, or indeed 4 structural breaks that the Czech economy experienced. The first one appeared when we entered the European Union, that's clear. The second one appeared around the global financial crisis, so 2008, 2009. The third structural break that we identify was linked or was placed around 2016. Here there is no direct macroeconomic or political factor that we can simply contribute, but it's a set of factors that are important, and I will speak about them in more details. That's the period when we plan to adjust the steady state in the model. And of course, the last structural break that hit the domestic economy is related to the recent period, COVID, Russian war, and all these things. So when we return back to 2016 or to the period of this year, it's obvious from the data, and that's the first picture, that the productivity somehow slowed down the growth. It was still growing, but by a lower pace. The tricky thing here is that indeed the economy was overheated, so we have to somehow discuss what or which part of the observed productivity can be contributed to the business cycle position of the economy, and which is related to the trend part. And from the picture, it clearly shows that the trend growth was slowed down. Indeed, these are hard data. We can search for other factors that might help us to explain what was happening there. That's the part of the appendix of the monetary policy report, and that's the kind of soft indicators showing that there were some changes in infrastructure, innovation, institution framework. There something happened during this period. At the same time, we used a growth model that was introduced by the World Bank, Solo-Swan model, and when we used the data to fill it into the model, also this model identified that indeed there is a period starting 2016 till 2023 when the potential growth of the domestic economy declined from roughly 3% to 2.5%. So that was the reason or the motivation for the adjustment. At the same time, when we are speaking about the equilibrium growth of the domestic economy, it's related to the convergence of the Czech economy to the European Union. And from the picture that is visible here, it's also clear that after 2016, the speed of the convergence somehow slowed down. Let's say the development was different, let's say, compared to the Poland, when the convergence even speed up. So the slower convergence also means that there is an impact to the real exchange rate equilibrium that is capturing in the model framework this situation, and that led us to also review the real exchange rate appreciation and keeping the inflation targets or differential the same for us for the Eurozone. The nominal exchange rate is also adjusted in the equilibrium. So using these changes that are incorporated into the projection through the expert judgments, then we add assumptions of the projections to have the baseline scenario. So the first set of the assumption is linked to the development in the foreign environment. Here we can see that the GDP growth in effective euro area is somehow muted during this year. It will increase during the next year, and the main driving force behind the improvement of the economic activity in the Eurozone is the contribution of the Germany. We are aware of the fact that there are cyclical structural problems in German economy, so indeed we also identified that this area, the development in Germany, the outlook of the global GDP, these are the factors that contribute to the risks of the projection. The muted growth is also linked to the muted dynamics of the producer prices in the effective Eurozone, so the contribution of the core foreign prices dynamics to the headline PPI is slightly negative. During this year, there is quite a big contribution of the energy prices, which indeed reflects the correction in the prices of commodities. So the decline is something like minus 6% for this year, and then we assume that for the next year, 2025 and 2026, the dynamics will be quite muted. At the same time, we assume, in line with the market expectation, that the ECB will deliver 2 cuts of the interest rates, the first one in September, the second one in December. These are the standard cuts, so the trajectory of the 3-month Euribor is slightly decreasing. The second set of the assumption is linked to the fiscal policy. Here, the numbers are impacted by the implementation of the consolidation package by the government. So it means this year fiscal policy is restrictive, measured by the fiscal impulse, almost 1 percentage point. Once these effects disappear, the fiscal impulse will be roughly neutral for 2025 and 2026. The consolidation package also impacts the consumption or spending of the government, that we can see that in nominal terms the spendings are gradually declining in their dynamics. So putting all these assumptions and the changes in the long-term equilibria together, the new projection simply says that the inflation stays close to the target, indeed, for the rest of the year, including next year and 2026. When we focus more in details for the rest of the year, indeed, the projection expect that there will be temporal increase of the headline inflation at the end of each of the quarters, so in the third and fourth quarter, which is simply the base effect from the previous year. There are no big changes in the taxation, so also the monetary policy inflation stays quite close to the target. Going deeper into the structure of the headline inflation, it's obvious that the headline inflation or the core inflation is contributed importantly to the dynamics of the headline inflation. For the core inflation, we just simply expect that it will stay slightly above 2%, indeed, for the whole projection horizon. What is typical here for the core price dynamics is the fact that indeed the prices of services will grow a bit higher than the core inflation itself. That will be compensated by the bit lower growth of the prices for the goods. In other words, there is some gap in between tradables and non-tradables that will continue also over the forecasting horizon. And it's important to highlight here that this gap is not something that will cause additionally inflationary pressures in the domestic economy. It's something that is linked to the convergence of the domestic economy to the Eurozone, and it will persist. Indeed, stable outlook is also for the food prices in general. Contrary to that, the fuel prices measured by the year-on-year dynamics will be declining over the whole forecasting horizon. And the last component of the headline inflation, the regulated prices, they will still experience 5% growth for the rest of this year, which is higher than the equilibrium. Then they will drop to the lower numbers at the beginning of the next year, despite the fact that there is increase in licenses fees. We can check also the price dynamics from the point of costs and profits at the macroeconomic level. So from the first picture, it's clear that the deviation of the market prices from the 2% is zero. So indeed, the market price inflation stays at 2%. What is relevant here is the fact that indeed there is a positive contribution of the costs. These are the blue bars that are pushing inflation up, and this is compensated by the negative contribution of the profit margins in the economy. The negative contributions here means that the profit margins are gradually declining towards their equilibrium, and this is because, or with the contribution of the tight monetary policy that will ensure that the margins will gradually decline. The second part of that, so the costs that are contributing in the inflationary pressures are driven mainly by the dynamics of the intermediate good prices, so the dynamics of the prices in the domestic economy. This is the contribution of the yellow bars. And if we check the details, what is behind that, that's the lower picture. The domestic costs are driven by the elevated growth of mainly of the wages in the business sector. They have a relatively high dynamics, especially in Q-on-Q terms for the beginning of this year, and then gradually they are converging back to the equilibrium. This is the result of the situation on the labor market, and if we measure the tightness of the labor market through the labor utility composite index, Lucy, then we can see that still the tightness is present in the labor market, but it's gradually easing. That's just the reflection of the fact that the economic growth in the previous year was muted, and with some lag, it's translated also into the labor market. The tightness is in the labor market is linked mainly to the real part of labor, so it means that the employment will continue to grow, although quite muted growth, and at the same time the unemployment rate will not increase significantly, it will just gradually increase. As I already highlighted, this results into the wage growth that was relatively high at the beginning of this year. It was broad-based. On top of that, there was an increase in minimum wage and also increase in doctors' pays or salaries. And this high Q-on-Q number for the first quarter will indeed keep the year-on-year dynamics for the whole this year relatively high. It does not mean that the Q-on-Q dynamics remains high. It will gradually decline and converge back to the equilibrium throughout this year. So the high wage growth in the business sector is related mainly to the first half of this year. The wage growth in the non-business sector, it's from the picture, it's clear it's lower than in the business sector, and it's impacted by the expected increase of the salaries of the government for some of the employees that government agreed in September, and the baseline scenario assumes that there will be an increase by 7% in September. Overall, the labor market shows that indeed the wage bill, the total wage bill, will continue to grow relatively robustly, and what is more relevant is the fact that indeed in real terms at the beginning of this year the wage bill turned into positive numbers. That's the driver and key factor when we speak about the consumption of the households as the main contributor to the growth of overall GDP. So it means the household consumption will support the recovery in the domestic economy this year and also for the next year. Next year there will be also a contribution of positive contribution of the investment activity. In total, it means that this year we expect that the economy will grow slightly more than 1%. Next year it will be almost 3%. For 2026, the growth is close to the new equilibrium that we impose to the baseline scenario, which is the value of 2.5%. After closing or finalizing the baseline scenario, we also received the numbers from the Czech Statistical Office about the economic activity. Indeed, these numbers were in line with our expectation for the second quarter, not only related to the story, but also the numbers themselves were quite close. So when we check the components that are important from the point of the economic growth, I already highlighted that there is big contribution of the household consumption driven by the recovery in real wages or real wage bill in total. That will be further supported by improving sentiment of the households, declining rate of savings, and on top of that also the declining or easing of the monetary policy conditions. I have already also highlighted that there is a contribution of the investment activity for the next year. That's the result of the fact that indeed the investment itself were quite muted at the beginning of this year. That's related to the private investment. The government investment or public investment were even declining, reflecting the EU fund period impact. When we check the contribution of the net exports to the GDP growth, it turned from the positive contribution this year to the negative one for the next year, and that's just simply the result that both of these components will recover the growth, and in case of imports, the growth will be faster than for the exports, implying that the contribution of the next export is negative. Continuing with the exchange rate, indeed the near-term outlook for the third quarter is set close to the current values of the exchange rate, and the exchange rate will stay at roughly at this level till the end of this year, and then it will start to mildly appreciate during 2025 and 26. The appreciation will be supported by the improvement in the exports. Against this, the factor that will somehow reduce or put pressure on the depreciation is the narrowing of the interest rate differential of the domestic interest rates against the Eurozone. Together it means that consistently with this baseline scenario, there is a modest decline in the market interest rates. And indeed, it's in line with the fact that the inflation and especially inflation expectation stays at the inflation target. So it means monetary policy remains still restrictive. And the reason is that it will ensure closing of the markups that will compensate the inflationary pressure coming from that are related to the dynamics of the costs, especially the impact of the elevated wage growth. Quickly, I will compare this projection with the previous one, but as I said at the beginning, it's quite close. So the new projection is slightly lower compared to the previous one for the inflation, that it's linked to the core inflation and food prices. For the 2025, the outlook is indeed the same. The inflation is at the target. For GDP, there is an impact of the historical revisions that were introduced, and the dynamics is slightly lower for this year as well. The revisions are also relevant for the change in the projection of the wages for the business sector. On top of that, the higher than forecasted wage growth in the previous projection led us to the revision of the wage dynamics for this year to be a bit higher. The exchange rate revision or change, it just reflected the recent development in the currency, so that's the initial point and the NTF outlook. Then the slope or the speed of the depreciation is the same as it was last time. More importantly, probably the change between the projection for the interest rates. Here, overall, we can say that the trajectory is slightly higher for the new projection compared to the previous one. But if you check the decomposition in more details, it's clear that for the third quarter, the trajectory is indeed exactly the same as it was last time. The difference is zero. Then for the next 3 quarters, the higher trajectory is negligibly higher. Bigger difference is related to the second half of 2025. If we want to check what are the forces behind this revision, then for sure it's the contribution of the red bars, which is the foreign environment, and that's the higher outlook of the foreign interest rates compared to the previous projection. What I would like to highlight is also the contribution of the expert judgments, that initially these are negative, which reflect the fact that indeed the starting point for the interest rates for the third quarter is lower by 50 basis points compared to the average for the second quarter. In other words, the cut in the interest rates was done last time at the end of the quarter, which did not impact the average for the quarter, but the starting point is lower. Then the expert judgments are contributing positively, which reflects first the higher dynamics of the wages in business sector, and second the adjustment of the long-run equilibria for the productivity, so lower productivity is pushing for higher inflation or generating higher inflationary pressures, and indeed pushing for higher interest rates. And I will close my presentation with a short discussion of the scoreboard that is right now regularly used during the policy discussions. And here, the broad picture just simply says that the scoreboard is indicating that the inflationary risks are getting lower or of less importance, which is clear from the fact that indeed the red colors are turning into orange or to be less important, that it's valid especially for the outlook of the government deficit or government sector balance, that we can see that the balance is indeed reducing, so generating smaller inflationary pressures. And then indeed the second relevant part that was in red is related to the inflation expectations, and both of these two pictures are showing that the inflation expectations are returning back to the normal, to the 2% target. So that's all from my side. Thanks for your attention.
Good morning. It's a great opportunity to meet you here collectively once a year, and I will use or maybe even abuse the opportunity to explain my view on one question that I received from you or other people individually, roughly each time in a recent year. It is the issue of R-star, neutral rate, or natural rate, and maybe finally the terminal rate. We did not have a discussion on these issues yesterday. We had it in May, but not yesterday. But still, I think it's quite important, as I say, because I receive that question anytime individually. When I started to lecture macroeconomics or monetary economics in 1990s, no one would really think that there was something like one interest rate stabilizing the economy. For practical reasons, there was something like equilibrium interest rate in the models of the time, but the importance of the number itself was quite limited. And that changed after the textbook by Michael Woodford was established as a Bible of monetary economics at the beginning of the century. It is a little bit paradoxical that based on the article old 100 years from a guy who was likely the early monetarist, the idea of one interest rate stabilizing the macro made new Keynesian macroeconomics extremely powerful. I personally had always doubt about the concept itself, and you can find a lot of research at the Bank for International Settlements website explaining that empirical estimates of natural rate can be of limited use or even misleading. Still, a lot of people think that it is essential and that it is very important, and we cannot ignore the issue. As far as the discussion in the Czech National Bank is concerned, in the board, we understand that we have hundreds of papers that show that in this century something which can be called natural rate was declining or has been declining quite significantly. And at the same time, we can see that most estimates in the last 2 years point to some forces that made the estimates of the rate a bit higher. And we also think in the board, or most of the board thinks that the experience from recent years, including the inflation episode and the previous financial cycles, makes the case for believing that the natural rate, if it is important is likely a bit higher than we thought a couple of years ago. So if you discuss or think about the terminal rate, or if you think about how far down the road we are going to go in the next quarters, you should consider what I was trying to explain.
So thank you very much, Mr. Frait, and also thanks a lot to Mr. Musil for his presentation. And now the floor is open for your questions. So let's begin. Yeah, Mr. Jáč.
Good morning, Radomír Jáč, General Investment CEE. I have a question on interest rate outlook, definitely as it is presented by the model, because there is a forecast for inflation standing perfectly in line with target over the next couple of years. But the new forecast was indicating just one interest rate cut for second half of this year, which was actually delivered yesterday. If I take it purely the model, how is it written there? Actually, I have to admit that we already received some explanation of that on slide number 20, as Mr. Musil was commenting. I just really want to clarify that the reason about, let me say, the very conservative interest rate forecast is the assumption about external environment, I mean policy of big foreign central banks, because I have to say that this is really quite fragile assumption, which is changing almost every day. I think yesterday also the board said that this is general uncertainty of their forecast. And the other point was the expert judgment, keeping the interest rate rather higher in the upcoming quarters. So for me, it is really about the clarification. Is it really all as regards the explanation of the interest rate outlook, at least for the near term? I would say this is the question for members of the Monetary Policy Department, but obviously I would ask Mr. Frait for his view on this as well, if possible. Thank you.
Good morning also from my side, ladies and gentlemen. I will start to give you an explanation on this issue, and my colleague and Mr. Frait will continue. Mr. Musil showed clearly in his presentation that the new interest rate forecast hasn't changed much from the previous quarter, especially when focusing on the third quarter of this year or the rest of this year and first half of next year. And the previous forecast, similarly to the new one, was saying that after a relatively sharp decline in interest rates taking place in the first half of this year, there will be a period of time when the further cuts will be done in a more modest way. And we are now approaching this period of time in which the further cuts may be, according to the forecast, done in a more moderate pace. And as you can see from this decomposition of the interest rate forecast change, the foreign interest rate outlook, which was entering the forecast around mid of July, when compared the same market outlook identified in mid-April, has been pushing the trajectory of domestic interest rates somewhat upwards. But the effect is not as dramatic, but it is quite visible. And I absolutely agree with you that the market outlook has been extremely volatile in recent months and quarters, reflecting the newly available data and communication of both ECB and Fed representatives on the effect of newly available data on their monetary and their monetary policy outlook. Expert judgments have traditionally been present at this decomposition as we try to take on board the mechanisms that are not fully covered by the existent model structures. In this particular case, this was the change in the equilibrium levels that were introduced at the beginning of Karol's presentation. And similarly to previous forecasts, we also somewhat adjusted the path of productivity and consumption recovery and wage recovery, wage growth in this forecast round. And what is still the part of the story is that keeping inflation close to our 2% inflation target on the whole forecasting horizon, including monetary policy horizon, is a reflection or is a response or consequence of the fact that monetary conditions in the interest rate component remain still restrictive. And this restrictive monetary policy stance ensures that inflation is kept close to our target, despite the nominal wage growth and the whole nominal marginal cost growth is above the equilibrium, above 2% in consumer sector, and that further decline in profit margins in both consumer and intermediate sector are ensured by keeping still monetary policy still tightened, ensuring the gradual decline of those profit margins back to their equilibrium. This is the same story as it was in the previous forecast, but as we approach within the monetary cycle to and closer to the estimated equilibrium or policy neutral rate, the pace of cuts is now somewhat slower.
Well, I just confirm that a lot happened actually after we made assumptions for this forecast, and today some parts of the forecast could be viewed as a little bit outdated. Nevertheless, if we look back at the last couple of quarters, there were a few situations when the expectations for short-term rates in the euro area, in the US, other economies, including Czech Republic, and then the longer-term interest rates went up and down quite significantly. And the situation that is viewed today can change quite quickly. So you should understand the forecast and the decision of the board as a part of a risk management approach to monetary policy. At the same time, the board is flexible and the bank is flexible, and the recent events are somehow reflected in the views on the balance of risk of the forecast. So we were not totally united in the view on the balance of risk, but generally we agreed that the risks are symmetric, so there are some pro-inflationary risks, and at the same time recent arrival of some pessimism or bad sentiment in the global economy made us understand that there are some downside risk of the forecast. So basically, we view it as relatively balanced, and we will respond flexibly to the information that we will see next.
Okay, so next question, please, Mr. Haverland.
Good morning, everyone. Thank you very much. My first question is about growth and the rates. So we see the rates rather elevated for this year and the next as well, with the real interest rate being rather high, and we still see the economy accelerating above the potential growth and close to potential in 2026. So the question is, whether you see the strength in the economy coming in when the rates will be quite restrictive and will tend to dampen the economic activity. And if we don't see that much growth in the second semester, we see little growth or almost no growth for some reasons, would the bank board be prepared to lower rates a bit more and a bit more quickly? And the second question is about the German scenario. It was always seen as the main downward risk to the Czech economy, obviously. And my question is, don't we right now see this negative German scenario to just be evolving, with the German industrial production just remaining on a steep downward trend, the Czech industrial production just getting there? And then what are the reasons for the German economy to rebound rather quickly on the forecasting horizon, as these issues are rather longer-term structural nature, like too much red tape, demography, low investment? So where does this optimism for the German economy come from? Thank you.
Again, I will start, and I will give the floor also to my colleagues if necessary. GDP growth acceleration for next year is stemming from basically three reasons. The first one is the fiscal policy stance changing from significantly restrictive this year to broadly neutral next year, which is difference in 1 percentage point fiscal impulse in terms of GDP growth. The second explanation is the recovery of consumption growth and domestic demand growth, which will be driven initially by the continuous household consumption growth, but this will from a part happen in this year already. And the domestic demand acceleration will be driven next year compared to this one by recovery in gross fixed capital formation, as both firms and public sector will utilize money from the new EU programming period, including projects regarding NGEU, and the current significantly negative contribution of destocking will turn into the standard positive changes in inventories contributions to GDP growth. That's why the GDP growth acceleration is a reflection of these three factors, despite the domestic monetary conditions remain restrictive, but the restriction has been moderating over time. As for the German situation, we have been observing the data, the political response, the structural pattern, and all the things very carefully and and we are not optimistic. I would say we are realistic when considering the German situation. It's true that the data published after the new forecast was finalized were surprising all of us on the downside, but still there is quite significant strength in a certain part of German economies, including new industries finding their driving forces, such as pharmacy, etc. That's why we expect that after the global trade weakness fades away, German companies that are heavily export-oriented and that can find their export territories around the globe will benefit from this global trade recovery, and the Czech counterparties, Czech firms that are heavily related to their mother companies from Germany will also benefit from this positive development. This is a cyclical story. The structural story is much more longer-lasting phenomenon, but still we believe, or we are convinced that all these weaknesses will also be gradually solved by respective German authorities to bring the German economy back on the better footings.
Sure, the board was discussing the implications of some worsening in the outlook for the global economy, and we were looking at the overall monetary conditions, and basically we agree that the exchange rate conditions have been relatively relaxed recently, and when we look at long-term interest rates, these are way too low and somehow automatically made monetary conditions less restrictive. So given the situation, we really don't have the dilemma, or we don't think that we should think about traditional trade-off between inflation and unemployment. So that confirms that our view is really in terms of a risk management approach to monetary policy. I mean, primarily inflation risk management approach.
Okay, thank you. Next question, please. Oh, so okay, please.
Good morning, Jaromír Getz, Komerční banka. I have one question on the neutral rate on the staff, given that you changed the equilibria of the potential growth of steady state appreciation of the koruna. My question is, what is the implication for the model steady state or medium-term neutral rate? And maybe also a question on Mr. Frait. I'm just curious about the recent change in board's communication regarding the natural rate, because pre-May meeting we heard from the board that it'll probably lies between 3.5% and 4%, but recently we are hearing more like 3 to 3.5%. So maybe if you can elaborate more on what was behind this shift. Thank you.
When introducing the changes in the estimated equilibrium variables, we, and Karol presented it very clearly in his speech, we did it this time in an expert way without changing actually the steady state parameters of the model. That's why the change in the potential output growth from 3 to 2.5%. And koruna appreciation trend lowering from 1.5 to 1% have not been accompanied by any changes in the real version of the uncovered interest rate parity. This will come into question when we will be doing the next forecast, during which we will change the parameterization of the model as such, and the discussion on the R star, on the country risk premium, its permanent part, its temporary part will also come into a question, and we will definitely consult with the board members to hear their view on the parameterization of the new parameterization of the steady state values of the model.
Yeah, I understand that you can be puzzled a little bit, but in my initial introduction, I was trying to explain that there is no unified view on the levels of natural rate, and even some board members, including myself, do not really think that it is a really reasonable, strong concept. And the reasonable estimates of natural rate actually fluctuate plus minus a few percentage points. So likely if you ask or if you listen to different board members, you can receive a bit different number, but generally if I'm to provide some response for the whole board, we simply stick to our estimate used in the model, that is 1 real, 3 nominal, and at the same time most of the board believes that it is likely somehow higher.
Yeah, Mr. Havalan again.
Thank you, David from ING. I've got one question for Mr. Frait. Do you consider or even for everyone, the current weakness of the Czech economy, and as well with looking to the quarters ahead, more of a structural nature or cyclical? And if we would not see enough growth in the second semester, would the bank board be willing to support the growth with lower rates? Or is there a certain limit where you think it's more of a structural nature and we are not getting with the support beyond some threshold? So if you could elaborate, please, on this.
I think we still consider monetary policy a bit restrictive in the restrictive territories. I myself do it as relatively slightly restrictive. And what is having a relatively strong restrictive impact on the economy is more sentiment than monetary conditions or macroeconomic policies, and the sentiment is really associated with fears of structural deficiencies in Europe or in Western economies. So that's what I can see it, and definitely the slow growth in the economy is a combination of cyclical and structural forces, and the estimate of the balance between structural and cyclical could be pretty individual, I think.
So we have time for one question, please.
Good morning, Vít Mikušek from Raiffeisen Bank. I would like to ask Mr. Musil about the short-term exchange rate forecast, which expects that that the koruna would retain a similar pace of appreciation as was expected last time, but according to a new forecast, we can see that you're clearly reflecting the current developments, and according to the forecast, we can see that the appreciation would not resume until the start of the next year. So could you please clarify or elaborate a bit more why the koruna would not start to appreciate earlier, when also, if I look back on the foreign environment outlook, we can see that that it is expected that for example, the German economy, our main export partner, is expected to rebound and contribute to the growth rate of the effective euro area already in the last quarter of this year. Thank you.
Yeah, there are indeed two factors that are impacting the outlook of the currency. One is indeed the exports or contribution of the net exports, the channel of the NFA that indeed pushes for the appreciation of the currency. But against this factor, there is interest rate differential against the Eurozone that is pushing in the opposite direction, and combining these two main factors, the result is that the exchange rate remains the same or roughly stable till the end of the year. Indeed, when we are speaking about the stability, it's more the last quarter of this year, because the third quarter, that's the near-term outlook, that is, the value is fixed at close to the values that we are observing.
So do we have any other question? Okay, yes, please.
Good morning, Roman Renda, Czech Chamber of Commerce. I will have a very short question, relatively general. When we look at the GDP growth forecast and at the contributions, we can see that the biggest negative contribution will come from change in inventories. And could you please elaborate a bit more, speak in a bit more detail about what is the reasoning behind it? What are the arguments why the change in inventories will have such a big negative contribution compared to other parts of the GDP?
The negative contribution of inventories is a reflection of the observed data we saw for the fourth quarter of last year and for the first quarter of this year, where we saw outright destocking in the economy, which was following the previous periods of quite massive build-up of stockpiling or build-up of stocks. Stocks of inventories when companies were not able to finalize some part of production, and they were forced by these circumstances to stockpiling, which was dominantly the period of time after the post-COVID reopening of the economies, but we saw some elements of this developments also in previous years. Last year, the global value chains got back to their normal functioning, and domestic firms, domestic export-oriented firms, were able to finalize their production and to export it, and they are possibly moving to just-in-time style of planning and operating. That's why we saw, for us, quite significant, quite surprising trend to this destocking, which was, as I was mentioning, influencing already the first quarter of this year. And we expect this effect to influence this year as a whole, but gradually evaporating over time, and we expect that firms will get back to their normal just-in-time style of operating, implying that the changes in inventories will start making the traditional slightly positive contribution to GDP growth over 2025 and 2026.
So anyone for last one question, please? So I see there are no more questions. So thank you for coming. Thanks a lot. Many thanks to our guests and all speakers, and see you again in autumn. Thank you.